On your screen, you'll see a comparison from October 29's forecast with the current May 2020 update. We'll start with the revenue portion. Looking at section 1.01 of the May update, which is general property taxes, this makes up about 16% of our revenue. Property real estate tax revenues are realized by a school district by the assessed valuation of real property located within the district. Real estate collection estimates are communicated to the school district by the Lorain County Auditor. In fiscal years 21 through 24, it is assumed that the real estate revenues will decrease based on delinquencies in payment and the expiration of the 23.85 mil levy. Revenue from the assumption that the renewal levy is passed is added back into the forecast on line 11.02, which you'll see later. Line 1.035, unrestricted grants, which makes up 71% of our revenue. Governor DeWine announced in May that the state would be cutting 21% of our remaining state funding amounts that were due to districts through the foundation. For our district, that would have been a loss of over $3 million. But due to our poverty rate in our district and the district's reliance on state funding, our loss of funding was capped at just under $945,000. This is not reflected in the forecast due to the timing of when I completed the forecast versus the timing of the governor's announcement. Moving forward, I anticipate a loss of about $945,000 from the state aid for the next 2 years. Line 1.04, restricted grants, which makes up about 7% of our revenue. This line is comprised of catastrophic reimbursement, economically disadvantaged, and career tech funding. No increase is assumed for fiscal years 21 through 24. Line 1.05, property tax allocations, which is about 2% of our revenue. This category represents the homestead and rollback revenue the district receives from the state of Ohio. This line has a direct correlation to the general property tax line. This is the 12.5% reimbursement that the state gives the district to make up for the taxpayer discount revenue. No increase is assumed for fiscal years 21 through fiscal year 24. Line 1.06, all other revenue, which makes up about 2% of our revenue. There's about a $326,000 drop from last year's actuals for fiscal year 20 due to the Medicaid reimbursement and the tuition revenue decreasing. For fiscal years 21 through 24, the continued decrease is tied directly to the decreasing enrollment numbers. It is also tied to the interest earnings since our cash balance available for investment decreases over the life of the forecast. Moving on to expenditures. Again, I have the October 29 forecast and the May update for comparison. They're on separate pages because of how large the sections are. Looking at line 3.01 of the May update, personnel services, which makes up about 22% of our expenses. You'll notice a substantial increase to this line beginning in fiscal 21. This is because the district will no longer be using the school-wide pooling funding model and will be returning to the more traditional funding model. Our salaries and wages will now be reflected in this line instead of being so greatly split between this line and line 5.01, which is labeled as operating transfers out. I assume a 3 to 4% increase to this line for each year through fiscal year 24. Line 3.02, employees' retirement and insurance benefits, which makes up about 9% of our expenses. This increase The increases in this line are directly related to personnel services and tied to no longer using the school-wide pooling funding structure. Line 3.03, purchase services, which is about 64% of our expenses. I assume about a 4% increase based on trending each year through fiscal year 24 for items such as utilities, printing, postage, legal services, meeting and conferences, student transportation, costs associated with our students being open enrolled to other districts, and other miscellaneous purchases and expenses. Line 3.04, supplies and material. There's an initial increase due to some instructional materials returning to the general fund from the school-wide pool. Based on trending, I anticipate a 1% increase each year thereafter. Large technology purchases will be paid for with grant funding. Line 3.05, capital outlay. I kept that flat throughout the forecast. This line captures technical equipment and capital fixed assets that cost greater than $5,000 per item. It also includes costs for land, existing buildings, equipment, vehicles, and other fixed assets. Line 4.30, other object costs. This line captures expenses not otherwise classified, such as audit fees, bank charges, liability insurance, tax collection fees from the Lorain County Auditor, and other fees and dues. On to the next slide. I want to take a quick minute to talk about the CARES Act funding. We will be losing a total of almost $1.9 million due to the state cuts to the foundation payments because of the pandemic. We will be receiving $3.9 million from the CARES Act fund. The CARES Act funding will help us cover our losses as well as pay for additional costs related to the pandemic. Examples of additional costs include materials and postage for curriculum that might be mailed to students, additional cleaning supplies and equipment, PPE, personal protective equipment such as masks, and technology for students and staff to be able to work and learn remotely. On to the next slide. This slide shows a comparison of what our fund balances will look like without the levy renewal and with the levy renewal. On line 10.1, this is the forecasted fund balances if the renewal levy is not passed. You'll see that in fiscal year 24, we would reach a negative $53 million balance. On line 12.01, this is our forecasted fund balances if the renewal levy is passed, which would leave us at a negative $43 million fund balance at the end of fiscal year 24. In closing, the main purpose of the May forecast is to update the current year actuals, update next year's budgets, and to trend future years based on new information. But we are in unprecedented times with this pandemic, and our numbers may fluctuate by the time we get to November's forecast. Even without the additional spending for costs related to the coronavirus, the district's ending cash balance is expected to decline each fiscal year. As mentioned, the district has a 5-year, $23.85 million operating expense levy, expiring at the end of December 2021. If this levy is not renewed, our district will lose almost $10 million a year in revenue. This will financially devastate our district beginning in fiscal year 22-23.